Welcome back, everybody. This video is going to focus on the current monetary system, and specifically, we're going to focus on the US monetary system since the dollar is the world's reserve currency. I'm going to try to make this as simple as possible, but I need everyone to understand that the way the financial system works is a bit confusing, which is why we really need to do this course and why it's so important to get this information out. So if you guys need to watch this video a few times, I highly recommend that. Otherwise, try to follow along. I'm going to try to make this as simple as possible. If you have any further questions after this, make sure to reach out to a coach and they'll happily walk you through it. But this is the way the current monetary system works. How does money get created? How does it show up in the economy? Where does it come from? So there's two institutions in the United States, and most countries have something similar to this, but we're strictly going to focus on the United States for this video. The two institutions are the central bank and the Treasury. And let's explain what those two things are, because a lot of the time people tend to think they're both the same thing. The Federal Reserve is the central bank of the country. The central bank of the country decides the monetary policy, which means creation of money, the supply of money in the economy, right? Is there a lot of money flowing around, or is there a scarcity of money? They get to control that flow. And then they also get to set the interest rate of money. And interest rate is the cost of borrowing. So you guys want to go get a car, when you go to borrow, or when you go to finance the car, there's an interest rate that you have to pay to borrow the money. When you go to get a house, it's $100,000 house, you go to borrow the 100,000, the bank wants an extra 10% on top, or whatever that rate is. That interest rate is the cost of money. And so the person or the institution that's in charge of setting how much money is out there and what the cost of that money is to borrow is the Federal Reserve. It's the central bank. Now, the Treasury, on the other hand, I want you guys to think about it kind of like the piggy bank of the government, okay? So the government doesn't have money. I want you guys to remember this. Governments don't really have money except for the very few that can create it, which is what we're going to talk about. And so what they have to do is they have to tax people that work hard, and then they get that money, and that goes into a bank account for the country. So let's call that bank account the US Treasury. It's the piggy bank of the government. When we pay taxes, it comes to this account. And then when the government wants to send out stimulus checks, or they want to send money directly to individuals, it also comes from this Treasury account. So it's really important to remember something, guys, for your notes. The Federal Reserve, the central bank, cannot give money directly to the people, directly to the citizens. It cannot print this funny money and then just go out there and give it out. The US Treasury has every right to do whatever it wants with that money, like go spend it in the national budget or to give it back to citizens. So the Federal Reserve can only give money to its member banks, and the US Treasury is the one that can give money out in the open economy. Very, very important going forward, okay? The current system, guys, these are both separate institutions. The Treasury is an arm of the US government. It is directly an arm of the US government, whereas the Federal Reserve is an independent agency. Okay, so it still works with the government. It's still technically under the purview and under the jurisdiction of the government, but they're their own thing. Under the Constitution, the Federal Reserve is not part of the government. Really important to remember. And so the last thing we're going to cover in this short video is how money actually flows into the system. So how it gets created and how it gets sent out. It's going to be real short. So let's work through that right now. So really quickly, guys, here's how this works. This is a current model that we're using, and I'm not sure when it started being used, but I want to say somewhere around the 2008 financial crisis. And a lot of people have different names for this. Let's call this modern monetary theory, MMT. And it's basically where Treasury and the central bank have more of a relationship. So they're not two different bodies doing two different things. They're sort of working together. So here's how this current system works. The Treasury, the bank account of the United States, it creates financial instruments from scratch, out of nowhere. These are called bonds. And so a government bond, for those of you guys who don't know, it's a piece of paper that says, if you loan us some money right now, we as the government will give you back this money later, and we'll give you some money on top. So if you give us some money right now, if you loan the US government some money today, they will pay you back with interest. And so the US government is a very trustworthy person to loan money to. They're not your neighbor from across the street. They're not your friend from down the hall. They are the person, or they are the institution that's the most stable when it comes to financials. So it's a pretty good place to park your money. They will create these bonds out of nowhere, okay? The Federal Reserve can create money out of nowhere. So Treasury can't create money. They can only take money from taxation. The Federal Reserve can actually make money out of thin air. So in the past, they would actually print it. Today, it's created digitally. They go on the computer and they say, and imagine how much fun this would be if we could all do this. You look at your bank account and you can add zeros to the end of things. You know what? I don't have 100,000 right now. I have 1 million. Let me just add a zero to the end. So that's kind of the game that the Federal Reserve plays today, where they can create money digitally. Now, they can't just do it whenever they want. So what happens is the Federal Reserve will create this funny money. The Treasury will issue these, imaginary instruments, and then the Federal Reserve will buy it from the Treasury. Okay. So Treasury creates these boo-boo instruments. The Federal Reserve has this money they just printed. The Federal Reserve gives the Treasury money in exchange for those bonds. So what happens? The Treasury now has a lot of money. Okay. It's freshly printed, new money, and they can then send that into the economy. Because remember, the central bank can't give money to people, but the Treasury can. So they're trying to bypass this system. How can we print money and give it out to everybody without breaking the system? Well, basically, they're playing this game. So then what happens? The Federal Reserve gives some of this printed money to its member banks, which are the 5 largest banks in the country. I'm not going to name them, but you guys know who they are, and they're in the mastery course. And then those member banks go out there and they lend it out to the real economy. So when you go to your a national bank and you want to go get a car loan, that car loan, the rate that they charge you and everything like that is based on this entire system. Okay, so it just trickles down. The Treasury creates these imaginary assets. The Federal Reserve creates imaginary money, and they buy those imaginary assets. Now that money gets sent out into the real economy, and then it gets loaned out to people so they can buy cars, homes, go to school, and other things. Okay, so that's the current system. The last thing we're going to talk about in this video, guys, is why is this system in jeopardy, or is the system in jeopardy? And can this system last, where we create imaginary things and then we create more imaginary money to pay for those imaginary things? Does that make any sense? The real answer is in 2008, when the world financial crisis happened, the global financial crisis happened, the whole world got to see that the system is not as stable as we all thought it was. This system of funny money going around and you're loaning it out, for every dollar that exists, there's $5 being loaned out. So it's this kind of like really weird Ponzi scheme kind of game. That's not sustainable in the future. And so the reason that Bitcoin came out is Bitcoin goes against what this entire system is. And we'll talk about that in future videos about why Bitcoin is so important, but you can't recreate more Bitcoins out of thin air. Somebody's not going to wake up one day and just say, hey, you know what? We're going to make 1 million more Bitcoins and put them in the system and ruin the value of the Bitcoin. That's not going to happen. So the difference between dollars, which are getting printed at record speeds nowadays in record volumes, trillions of dollars are getting printed out of thin air and being introduced to the system. What that does is it actually ruins the integrity of the money you're using, right? It's like playing a soccer game and then everybody gets a ball, right? No, everybody gets a ball. That doesn't really make any sense. You can't really play because it's just going to ruin the value of what the ball is. No one's going to fight over the ball because everyone has one. So the value of the dollar is going to be in jeopardy. Bitcoin is the exact opposite. You can't make more Bitcoins, and so it's only going to go up over time. And that's what we're really going to be talking about in this course, is that dollars and currencies in general are going to be going down over time because we're printing more of them. But Bitcoin, on the other hand, is only going to go up in value because it's priced in dollars, and it's going to take more dollars to buy a Bitcoin in the future. So we'll talk about those later. I want you guys to go back and rewatch this video if it doesn't really make sense. It's just very important to understand that we're creating money out of thin air. That's the biggest piece. So this funny money is sloshing around the system. I hope that you guys enjoyed this brief understanding of how the monetary system works. The next video, we're going to go into the introduction of blockchains and cryptocurrencies. Very excited to share it with you guys. See you there.